Welcome to the first in what we hope will be a series of events held jointly between the Saïd Business School and the Reuters Institute for the Study of Journalism. I'm David Levy, I'm Director of the Reuters Institute, and I'm really grateful to Peter Tufano, Dean of the Business School here, and his colleagues for working together, for hosting us here and working together on this event. Sorry about the late start, but we'll make up for it. Thanks also to Alan Rusbridger here, who conceived of this event back in the spring, which was a time when we were talking about how we could understand what was happening about advertising income that's funded news for so long, and at what looked like a pretty dark time for publishers. The Independent newspaper had just announced that it was about to close its print edition in March. The Guardian was heading for losses of 50 million and planned cuts of 20% of its staff. And since then, things haven't got a lot better. We've seen more of the same this month. Britain's newest newspaper, The New Day, folded just after 3 months, I think. And this week, the Daily Telegraph announced a round of cost-cutting measures. And today, the owners of the Daily Mail announced a 29% fall in profits, driven by a 16% fall in print advertising in the past 6 months in the Daily Mail and the Mail on Sunday. It's not just a problem for the so-called legacy brands operating in print. Many are seeing their online advertising revenues down too, hit by the move to mobile consumption, the rise of ad blocking, and the content increasingly being consumed off-site on sites like Facebook and others. And even the poster children of the internet age are not immune from these chill winds. The Financial Times reported recently that Buzzfeed had missed its profits targets for 2015, its turnover targets for 2015. Vice Media is now laying off 20 staff, and Mashable, I think, has been reported laying off 30. So I feel that while we might have decided back in March on our question for this evening, news after advertising, it now sounds somewhat too prescient. But if the world looks tough for publishers, rest assured that we've got a superb group of speakers here to help us understand what's going on. We're really fortunate to have Martin Sorrell, a sort of towering figure in the advertising business. Not so towering, well, true. True. Peter will introduce Martin in a minute. We've also got Simon Fox, CEO of Trinity Mirror there, and David Abraham, CEO of Channel 4 here. And they're going to give their perspectives after Sir Martin on how the trends in advertising are affecting their aspects of the content business. That we'll do that in a discussion chaired by Alan Rusbridger here. I'm really grateful to all of them for joining us this evening to explore these issues, and to all of you for coming along to take part in this conversation. Now I'm going to hand over to Peter Tufano.
Thanks so much. Thanks so much, David. So we're thrilled for 3 or 4 reasons about why this event is being held this afternoon. First, we say that we're embedded in a university, and what that means is we love to work across the university, and this is our first event with our friends from the Reuters Institute. Second, this seems to be journalism week for us. Earlier this week we had Christiana Amanpour, who was here. And journalism isn't normally what we think of as a business school, but the free flow of information is critical to our economies and our societies. And on Monday we talked about that, and today we're going to talk about the counterpart of that, which is the business side of this. And as a business topic, this is particularly important. And you've already heard about some of the events that are going on right now in the business of journalism and the media. But mostly I'm excited because I'm thrilled to have Sir Martin Sorrell here. 31 years ago, if we looked at the landscape of the world, nobody would have known about, is it wire and plastic products? That name would not have tripped off anyone's lips, but the names that would have tripped off your lips would have been J. Walter Thompson, Ogilvy and Mather, Young and Rubicon, and a bunch of others. Those were, in fact, and this was when I was just starting my business career, those were the firms, the big firms in this space. All of those are now part of wire and plastic products, or no, it's WPP Group. And throughout that whole time, since 1985, Sir Martin Sorrell has been at the helm of WPP, forging partnerships, acquiring firms right and left, creating new models, new business models. He may not know this, but I've worked with his firms over the years. And really becoming the place where advertising, market research, and really everything to do with marketing and the media world has come into one place. So it's been a long hope of mine to bring you to the school, and I'm glad that we're finally able to do that, even though you went to the other place, which is okay. Thank you so much for coming and joining us today. With that, over to Sir Martin.
So it's the wrong places, actually, because, you know, there were two places.
Well, I was in the other place.
Yes, I know, yeah, but fine, so people might figure out what the hell we're talking about. Okay, so I assume everybody can hear me all right, even at the back. So, God, it was exhausting getting here. So, you clamber through London and cursing Boris and his bike lanes, and you get here about, we thought we were going to be late, and then we were, there was a flush of enthusiasm when we got to Oxford at around 5 o'clock, and then we hit Oxford traffic. So I don't know whether Boris and his bike lanes have hit, it probably has, Oxford, but it's enough to make you want to vote for Brexit. Or maybe not. Okay, so the brief I got actually was to talk generally about how we see the world of, and the word that was used was advertising. And we don't call it advertising. I've got 30 minutes, is that right? Yes? Okay. We don't talk about advertising, we talk about, actually we call it communication services, and to be honest with you, I don't think we've come up with any, the right phraseology for the business that we're in. So, and this is headed news after advertising. So I'm going to try and weave in, on the lamb or on the wing, stuff about news as well. And I just want to start off actually by saying, I mean, this time last year, or coming up in a couple of weeks ago, we go to Cannes for our industry Oscars, the Cannes Lions. And last year, we had the new editor of The Guardian, Shane Smith of Vice, and I think it was Mark Thompson. I don't think I'm doing yes, it was Mark Thompson, now of the New York Times, ex the BBC. And what was really interesting, we were talking about very much this subject, and what was really interesting is that, and maybe I shouldn't be too aggressive, but two of the three people just don't get it, what's happened, right? I'm not saying that we do, that I do. The only person who really, I think, understood what's going on, and David mentioned that Vice Media has sort of cut a few people, but The Guardian and the Daily Mail and News Corp and others should be so lucky that they were performing as well as Vice. The only person who got it was Shane, and the other two are sort of stuck in a time warp. And the reason I say that is this: it's not, they believe, the oldies, of which I'm one, and the wrinklies, believe that young people are not interested in news. Wrong. Young people are, however you define young people for a minute, whether they're millennials or centennials. Centennials are not 100-year-old people, by the way. These are people who've, from 1997 onwards, the Snapchat generation. So you better call them the Snapchat generation versus the Facebook generation. They're two different generations in our view. They are really interested in news, but they're interested in it being presented in a totally different way. And that's the point. So I think the level of interest is exactly the same as it was in my day, but Buzzfeed was mentioned. I don't personally, this is being filmed, isn't it? So I have to be careful what I say. BuzzFeed doesn't appeal to me. I think it's great headlines, but I don't think the content is particularly great. And I think that's part of the problem. But young people are interested in news. I mean, if you watch some of the HBO deal that Shane Smith did, which was, now get it right for a minute, there were, I think it's 41 1-hour, 60-second sort of specials, and 50 weeks or 46 weeks of daily half-an-hour news programs. I think that was it, and it was for a 4-year deal, I think it was, if I remember rightly. I mean, it's a big deal on HBO. So kids are interested, but it's a different. And what I'm going to talk to you about, that's, actually I should just say, so Peter was very polite about WPP. It's not as messy as that. The theme this year is Cuba. I just mentioned that. So a year ago, we have an artistic theme every year. Last year it was Africa. Some of you may have seen the leopard on the front. This is an ad. It was voted the best annual report in the world, both online and offline. This year, we sat and scratched our heads, and I said, why don't we do Cuba and Iran? We take a Cuban and Iranian artists. I was forbidden to bring Iranian artists in. Maybe that's going to be next year's theme, but we did Cuba. So that's a car. This is not art. This is a car from Cuba, so that was the theme. I was in Havana last week on Thursday and Friday, interestingly. If anyone wants to talk about Havana, we can talk about that. We can talk about news in the context of Havana, actually. It's quite in Cuba, it's quite interesting. But that was the theme. WPP is not organized like that. This is just the brands that we've built because, and this is relevant to news in some senses, creative industries suffer diseconomies of scale. The perception is, and I underline the perception is, the bigger you get, the worse it gets. That clients think the bigger you are, the worse you are, and perceive that you are. And people think the bigger you are, the more difficult it is to run, and therefore it's a bit like universities. The bigger they get, sometimes people think the worse they get. I'm sure that's not the case at Oxford or Saïd. So that's topic. Now, just to remind you of the hard facts, and this is really important. The first line is really important. Our billings are 73 billion. It's important also because people of diminutive stature, like me, like to talk about big numbers rather than small numbers. And so the 73 billion is the biggest number on the table. And just to put it in perspective for a minute, that's the media that we buy on behalf of our clients. It's not our money, it's their money, but we funnel it through to the media owners. And that's about, according to most of the research, about 25% to 30% of the worldwide media market. And it's obviously a mixture of online and offline. Our revenues are 19 billion. And by the way, that's important because that's the real leverage inside the company. The driver of, I think, advertising and marketing services business or communication service business is the revenue number. It's interesting, we're the only company in our sector that gives you an audited number. The RECMA number, if any of you know who RECMA is, it's a French research company that does rate card analysis of the size of the groups, puts our figure at 106 billion. So it sort of tells you about the difference between rate card and actual rates. But that's the driver. And 19 billion of revenue excluding associates. Associates are companies that we own 20 to 49% of. And investments, if you include investments, 27 billion, that's companies that we own under 20% of. Net sales last year were 16 billion. Net sales is really important because it compares to the revenue figure. Again, we're the only company that gives a net sales figure. Why do we do that? Two reasons. One is we have a data investment management business. It used to be called market research or consumer insight. We thought if we called it data investment management, the revenues would, or the net sales would rise faster. It's had a little bit of an effect. We thought it'd make it sound a little bit more important, but not as much effect as I would like. But the net sales figure reflects the pass-through costs on data accumulation, on which we charge no margin. And really importantly, it reflects the increasing amount of online inventory buying that we're buying. Traditionally, we never bought traditional offline inventory. With online, because it's much more fragmented and we can use our leverage much more effectively for clients, we're buying more inventory. Not a lot. Our online billing platform, Xaxis, which is the largest in the world, is only $1 billion in billings. Our performance billings are about another $1 billion. So only 2 out of the 73 are in performance and programmatic. But what's really important, it's somewhat controversial, you may have seen some of the things going on in America almost as I speak with the ANA asking about transparency. But what we did with our programmatic inventory is we went to clients and we said, you can opt in. We're not going to do it on an opt-out basis. We're going to rip up your contract. So it was about 4,000 contracts actually that ripped up. And you can decide whether you want to opt into a system where we buy the online inventory. You will not know the price at which we buy the online inventory. You will know the price at which you buy it, and you'll be able to compare it to the market. But it was a very different approach, certainly in media planning and buying, and quite controversial in its way. We call it transparently non-transparent. And And it's really interesting because we reckon it's our own figures, it's not, you know, sort of independently audited figures, but our own figures indicate that we're about 20 to 30% cheaper than the market. So very interesting changes taking place. EBITDA is 3 billion. We're capitalized now, or a market value of 30 billion, so it's about 10 times EBITDA. And just to Peter's kind point, we started, when we were wire and plastic products, we started with £1 million or $1.5 million of market cap, and it's now 21 and 30. And to that point, this is the compound average growth rate. It's about 30% on the top line. It starts, as you see, in 85, and what's interesting about this is everything is cyclical. You know, the moment you think that things aren't cyclical is when the trouble starts. But there are three big cycles, or important cycles. One was 91-2, one was 2001-2, which was the internet bubble, and then Lehman was 2008, actually back end of 2008, but really 2009. Out of 31 years, we only had 3 years. I mean, ours is a cyclical business, but we only had 3 years when our sales really tailed off in nominal terms. Obviously, this reflects acquisitions as well. So that's that. And in terms of EPS, we had a near-death experience. We really got into trouble when I over-leveraged the company after the acquisition of Ogilvy in 89-90. We went into that recession in 91-2. We did a rights issue. That's why we started from, actually the compound average growth rate will be significantly greater if we went back to 85, but we do it to be a little bit fair. You can see EPS growth has been 14%. Strategy, this is really important, I think, from the context, not so much of news, but you understand what we're trying to do. We have this terrible word, horizontality. I doubt that it exists in the Oxford English Dictionary, but what it is we have 190,000 people in one way or another in 112 countries, the 112th being Cuba, and it's really that we want our people, or rather our clients want our people, to work together in the most effective way. And so we're really focused on trying to get our people, and there are two horizontal mechanisms. One is client leaders. So our biggest client is Ford, second biggest is Unilever, third is Procter, fourth is Nestle, fifth is VW. We're trying to get people to work together much more closely for those clients and organized by clients. Because if we were going to start an advertising agency or a marketing services business, if you really think about it, you wouldn't create vertical silos. You would create horizontal client groups that worked across the world. And what clients want from us now is people working together for their benefit. It is true that they are fond of brands, but they were historically more fond of brands than they are today. Today it's about effectiveness, which means better work, and efficiency at lower cost. They want more for less. So they want us to come together, and Ford, which is, I won't even mention the figure, but it's a massive piece of business out of that 19 billion of revenues. And we run it through a thing called GTB, which is a worldwide seamless, literally seamless. We've integrated the whole thing, and we've created an incentive system that divvies up to the verticals, that is proportionate to the amount that the verticals contribute, so that their incentive pools are maintained. So externally to Ford, it's one unit. Internally, we still maintain the vertical structure we have. We do the same thing for Colgate with Red Fuse on a smaller scale. So those are the two most horizontal of our approaches. But it's client leaders and it's country managers. I do not believe that any company, so we have 112 countries. Muhtar Kent of Coca-Cola tells me that Coca-Cola operates in something like 200 countries. And I say, Muhtar, there aren't 200 countries in the world. I mean, I think at the Olympics in Brazil, depending on how many countries actually turn up, I think there are about 206 countries, right? But you know, you get the independent state of some place you never heard of going past. But it's impossible for anybody at the center of a company to know what goes on in 112 countries, let alone 120 or 180 or 200. So the structure has to be client-driven and, in our view, country-driven. And the best articulation I ever heard of this was by Jeff Immelt at the Microsoft CEO's conference about 3 years ago when he said what GE was doing and was moving to 19 business units, reporting directly to the center. And he was going to get rid of regional management. I don't want to offend any regional managers in the room, because regional managers had the power to say no, not the power to say yes, and they stopped things going down, they stopped things going up. Now, we have been writing about this in our award-winning annual report, which mimics very weakly Warren Buffett's Berkshire Hathaway report for years. And I was delighted that finally somebody saw the light. Ever since then, when GE jumps in, a lot of people follow. And a lot of companies are doing this. And we as an organization spend about 1.5% of our revenues, something like that, on regional management, because we have to face off against our clients. Our margin's around 17% on net sales. Our target is to get to 20. So, the delta of 300 basis points could be largely filled by us doing something about structure. But what's happening, and I'll come on to this later, what's happening inside organizations from what we see is they're much more global, so that's the client, and they're much more local, that's the country. And those are the two general trends. The other three things that we focus on are fast growth markets, meaning bricks and next 11. Jim O'Neill was really the person who pushed that. It's not just about Brazil, Russia, India, and China. In fact, the only one of those four that is really motoring at the moment is India. Brazil looks a little bit better with Dilma's removal, but still long-term challenge. I'm still bullish on Russia in the long term, but it's a very long-term deal. China, jury's out a little bit, but it's 11 trillion out of 72 trillion worldwide and against 16 trillion, 17 trillion in terms of GDP for the US. So even if China's growing at 3 or 4%, which I think it is, the delta on China is as good as, and actually a little bit better than the US. So this year, in our industry, it's the G2 that dominates in terms of the delta growth. China, it will still be the biggest delta this year, despite the fact that the growth rate has slowed significantly. So we still think the fast growth markets are important. And the other message is the next billion of consumers in the world are not going to come from the US and Western Europe. They're going to come from Asia, Latin America, Africa, Middle East, and Central and Eastern Europe. So any concerns, or the concerns about the slowing of growth in the so-called fast growth markets, long term, we think are misplaced. They're 31% of our business, about a third. They haven't grown as fast as a proportion of our business over the last few years because of currency. The devaluation of the rupee, of the RMB, of the real has meant, and other currencies, the ruble has meant that they haven't grown as fast, but our target is still 40 to 45%. Digital doesn't suffer from the currency thing because digital is affecting all markets, fast growth and slow growth. It's actually affecting the fast growth markets faster because there's a leapfrog phenomenon. So, for example, we did a report on Myanmar this week, on brands in Myanmar, and it was entitled The Leapfrog Economy, or I think potentially The Leapfrog Economy. And by that I mean, and it's very true of Cuba actually, on a much smaller scale with only 11 million people. These economies have the advantage they don't have legacy systems that slow people down. You leapfrog from analog to smartphones. You don't go through analog, desktop, mobile. You can go straight. So you're not sort of held back by what's going on in the mature economies that have to take down at great cost and change legacy systems and change the way people do it. So digital, almost 40% of our business. The market is about 28, 29%. The world is about 28, 29% digital, acknowledging it's very difficult to define anymore what's digital and what's analog. But we use this as a sort of a measure of where we're going. We want to be about 40 to 45%. We'll achieve that, I think, within the next couple of years. Data investment management, that's the old research, consumer insight business is 25% of our business. That's where we want it to be. So that's the strategy. Now you had that messy car, that flashy American car, Cuban car, and you had all the brands. Actually, we are 11 verticals. So Peter mentioned J. Walter Thompson, Ogilvy, Y&R Brands, and Gray. There's 4 verticals. So these are the people that report to us from the center, that we go through our 3-year plans, our budgets, etc., the leaders of our business. There are 11 of them. So you have the 4 agency brands. You have Group M, which is the company that manages that 73 billion, consisting of 6 agencies now, one of which is Essence, which is the Google digital agency, which we acquired in November of this year. I'll come on to the digital makeup of our business, where we're spending the money on behalf of our clients. Kantar is the data holding company for brands like TNS and Millward Brown and Kantar Media. We measure media, by the way, in 52 markets of the world. So we are the non-US Nielsen. We're the second largest research business in the world. HK Strategy is one of our PR brands. Other PR brands are locked into the agencies on the left-hand side, the 4 of them. The B2D group is branding, identity, and design. Group H is healthcare. WPP Digital is what you'd expect, and specialist communications are other specialist communications area. Also heavily digital, but more general. Now, that's the background. So 10 things, just want to flip through very quickly about what we see happening in the world that frame any discussion about news or any other media in our view. The first is, before I get into the 10 things, and this is the fundamental reason why the Daily Mail's figures were so bad. So what's happened in the UK? We were just talking about it. In the UK this year, UK alone, circulations of newspapers and magazines, including their digital circulations, are down by about 6 or 7%. Advertising is down by about 15 or 16%. And usually the Mail Group, Sunday Mail and the Daily Mail, was immune from this. But now we can debate. I don't think the jury is out as to why this has happened quite so viciously since January of this year. You know, we are 35 to 40% of the market in the UK in media. So we know pretty much what's going on across all media, including digital. But the fundamental reason is that the new normal, you know, you're not even a Goldilocks economy. You're not too hot, not too cold. It's sort of at a cold level. It's low GDP growth, 3 to 3.5%. That's worldwide growth. The range is real versus nominal, so inflation is only 50 basis points, and that tells you the real problem is that our clients, there's little or no inflation, they have little or no pricing power. Big issue. If you went back in time, they had a bit of more inflation. Having inflation in the system gives you a little bit more pricing power. And the result is a total focus on costs. I'll come back to it, the rise of procurement and finance. As an ex-CFO, I think I understand it, but I should tell you that 50% of the FTSE 100 CEOs are ex-CFOs. What do you think their mentality, and faced with this sort of environment, what do you think their mentality is going to be? The other thing is, if you're running a legacy company, which most of us are, I am, Trinity Mirror is, Sony is, you're faced with this. Disruptors on the left, so you have Airbnb and Uber, I take them as examples. You're in the hotel industry, in the car industry. Ford is our largest client. I couldn't believe 3 years ago that they will be faced with the mobility and technology issues, sharing, Uber. I was at that same Microsoft conference, but about 2 years later, Mary Byra was sitting where you are, and Travis from Uber was sort of sitting where I was, and he looked at Mary Byra and said, this is in front of a group about this size of CEOs, and said, I'm going to put General Motors out of business in 5 years. Modest guy, but quite able, but not profitable. A lot of revenue, but not a lot of cities, but not profit. But disruption, okay, at one end. And by the way, not forgetting 3D printing and robotics. Okay? So disruption at one end. At the other end, you have the zero-based budgeters, 3G Capital, the Brazilian Jorge Lehmann. 3G Capital is remarkable. ABI, its principal big asset, has got, anybody know the market cap of ABI? $200 billion. Market cap of Kraft Heinz, $100 billion. And I'm ignoring Burger King and Tommy Hortons and any other thing there. So they have 300 billion of market cap at their disposal and control. The biggest packaged goods company is Nestle, which has about 250 billion of market cap. Coca-Cola is about 180, 190. Pepsi is about 140. Kraft, Mondelez is about 40 or 50. They could do anything they wanted to do in the packaged goods sector. So they have tremendous market power. Reckitt Benckiser is about, I think it's about 60 billion US, I think it's about 40 UK. And then you had Endo and Valiant. Now those are discredited in the pharmaceutical industry, but they were very important because what they did was they put pressure on the pharmaceutical industries, on the cost. You remember that what Valiant did, Michael Pearson, an ex-McKinsey consultant, came in and he wiped out R&D spending. Actually, on the marketing side, interestingly, they were quite aggressive, particularly on digital. But he wiped out R&D. So have you ever heard of a pharmaceutical company that didn't do R&D? Or one that was going to carry on for a long period of time? I would argue any company that doesn't do marketing won't prosper, and I'll come on to that in a second too. So you have the zero-based budgets, and in the middle, you have the activist investors, Aikman, Loeb, and Peltz. And if you think they don't have power, Dow Chemical and DuPont are merging, forming a $120 billion company, and they're splitting into three. Andrew Liveris would say, and with some justification, that it was his idea, but he was pushed into it by Nelson Peltz. So these guys have tremendous pressure. They say they're interested in the long term. We say in presentations like this they're interested in the short term. And often on earnings calls, they have people listening to us. So I get this email from, I won't say which one, he says, Martin, I'm really disappointed that you think we're looking at the short term, we're interested in the long term. So I say, well, I'm disappointed that you're disappointed, but that's the perception, and maybe you need a big advertising and marketing campaign to change the perception. And I never get an answer, except, actually, very interestingly, last week, Dan Loeb and Bill Aikman got together to do just what we said. I think they're going to do a sort of a little bit of a lobbying campaign to try and get people to think they're interested in the long term. The third thing that really I think is fascinating is the average life of a CEO, longevity of a CEO, is about, about 6 to 7 years. A CFO is 4 to 5, and a CMO, those are the people we tend to deal with, 3 to 4 years. It has been even shorter. Some people said it's 18 months in America, and it went up to 2 years. What do you expect? Other than a focus on the short term, and that's the problem. Now, this I think is the killer chart. So this tracks share buybacks and dividends since the beginning, virtually, of 2009. So just after Lehman. Lehman was Q3 of 8, and the blocks, the dotted line is 100% of operating earnings, or retained earnings. The blocks are buybacks and dividends, and you can see it was around, 50, 60%. In 2009, and by Q1 of 15, it breached 100% for the first time. And in last year, only one quarter was it less than 100%, and Q4 it was 120%. So what does that say? If you think about the S&P 500 as being one company, and by the way, this includes companies like Alibaba, because this is the 500 quoted in the US, with a lot of overseas earnings. I think it's about 50% of their sales, don't quote me on that, but you can check the statistic yourself, are from overseas. But what it says is, if you think about it, one company, it shrank in 2015. I don't know what the first quarter of 2016 is, but I bet you it's close to 100 or maybe more. This is abrogation of responsibility by management. They're saying, we don't know what to do with the funds that we generate, so we'll give it back to the shareholders. It's a totally short-term world. And the reason that spending on newspapers in the UK is down is because people are not investing. And you may think that that's a good idea, but think again. We do brand valuation every year. We've done it for, this data hasn't been published in the FT, we do it with the FT. And we do it, this is the 11th year, that we will have done it. So this is the data that we will publish on June the 8th in a special supplement. And the blue line is the top 10 of the 100 most valuable brands in the world, according to our analysis. They're all listed companies. You had to be listed to qualify because we use the Bloomberg data for it. And we take the top 10 and we invest equally in them. And over that period of time, over the last 10 years, the index of that investment would have gone up by 106%. If you invested it in the S&P 500, which is the pinky one, it's about 60%. So you'd outperform the S&P 500 by about 2/3, 70%. And you're 5 times the Morgan Stanley Worldwide Index. And interestingly, we launched the Chinese, well, not launched, we had the 6th edition of the top 100 brands in China, and the data shows exactly the same. Actually, the Chinese index, stock market index, the MSCI index was down, and I can't remember what it was up by, the Chinese brands were up by, but they were up significantly above. I mean, it was a very substantial increase. So it operates on that basis. Now, 10 quick things. Any Americans in the room? Okay. Yeah, I thought you were Welsh.
Whatever you want.
New York is still the center of the world, but the world's changing. It's moving to the south, and despite the travails of Brazil, Argentina has turned around amazingly under Macri. He's sort of done a Modi-esque, certainly the first stages of a Modi-esque change in Argentina. But Brazil's under pressure. I think we see some signs of growth in Mexico, Peru, Colombia a bit. But the south to us is becoming more and more important despite some of the challenges. Southeast meaning Africa and the Middle East, again, despite the challenges. Nigeria, Paul Pullman, our CEO of our second largest client, says Nigeria is the China of Africa. We'd agree with that, but Nigeria is a very difficult market for some obvious reasons, particularly difficult. But it's the southeast and then to the east, meaning India and China, but not just India and China, because actually the next 11, which includes Iran, interestingly, in its original analysis by Jim O'Neill, the next 11 last year grew very rapidly. So the civets, which are sort of Colombia, Indonesia, Vietnam, Egypt, Turkey, South Africa, the MIST, Mexico, Indonesia, South Africa and Turkey, I think they are, grew last year by about 11 or 12% for us. So really strong. So you are seeing some strong growth, not just in the majors. India is the one, as I said, that's growing fast. So the world is changing. And Americans, part of the Trump phenomenon is the discomfort that the Americans have, in fact, that we all have, because there's populism in this part of the world too, that we all have with the rise of China, India, Brazil, less so obviously in the short term, but these other markets. And if you go back to the early 19th century, China and India were, what are the BRICS and Next 11 by definition, were 40 to 50% of worldwide GDP. And what you saw was a long-term decline. So China's been on the wrong side of history for 200 years. My view is it's not going to be on the right side of history for 200 years. And despite the current difficulties, that's inevitable. And if you think that's a silly statement, just think that America went through the Great Recession in 1929. And that was on its 100 years to becoming the world's dominant economic power. And part of what Trump is about is the difficulty coming to terms with the fact that America is not as powerful relatively as it used to be. And it's not just China, it's India, it's Indonesia, because you look forward to projections for 25 years hence, you get a shock in terms of what the populations will look like and GDP on an absolute level, if not on a per capita basis. So that's one. The second thing is, in most industries that we operate in, demand is less than production. So car industry, our number 1 client and number 5 client are automobile companies. After Lehman, the big three in Detroit, Ford was the only one that didn't go to the government for money, but all cut back on capacity. And in 2009, the US car market was about 17 million units. And in that year, the world could produce 80 million units and the world could consume 60 million units. You would think that supply diminished post-Lehman. It hasn't. The fall in America in terms of production has been replaced by rises in China, in India, in South Korea, and some other markets. And the world still today can produce 80 million units and the world can consume 60. America's gone from 17 at Lehman to a low of 9, and it's back to 17. The Chinese automobile market is 22 million units, and people project that it will go to 30 million units. But demand is less than production. Now, good news for anybody coming out of the Saïd Business School, or any other business school for that matter. The demand for talent is greater than the supply. And if you look at the demographics of every major country, I was looking at something over the weekend, and it was done by UNESCO, I think it was, which was a sort of moving graph of the average age of all countries in the world. And by 2060, all countries, even young countries like Mexico or Pakistan, are going to be old. And the fertility rates are declining, and the birth rates are declining, family formations are declining, so the supply of talent, if you think it's a talent war now, stand by. So finding, keeping, incentivizing, motivating people is going to become very, very important. Disintermediation, very relevant to news. What does it mean? 3 things. You get disintermediated by these disruptors, you get disintermediated by a lower cost business model, and they steal your talent. Young people like to work in technology companies and less bureaucratic, more networked companies. And highly relevant to news, this is data from a woman called Mary Meeker. You may remember her in Internet 1.0. She was a very famous analyst. She's now a partner in Kleiner Perkins, and it compares time spent, that's the yellow, this is 2014 data. It's required reading. She comes out with a presentation at about this time of year. It's online, you can Google it. It's about 100 slides on the digital economy. And this is one of our favorite slides. It's for 2014, so we'll see the 15 data shortly. Time spent with yellow blocks against what the advertising industry invests, not WPP, what the industry invests. So, felling trees and distributing newsprint, traditional newspapers and magazines, 4% time spent, 18% investment. Radio is about right. If we included out of home, be about right too. She doesn't include it. Linear TV, so this is networks, not over the top. Linear TV, for the first time we started to see a gap. 37% of time spent, 41% of investment. Internet actually, surprisingly to me, was about right in terms of the balance. And mobile was the big gap, because we haven't figured out the best ways of putting creative on mobile. We don't measure it effectively. There's a lot of things to be done to get the balance right. So what it means is, the data that you heard about newspapers. This is not UK data, but the correction is taking place. And media owners get very upset, newspaper media owners get very upset when we use this. So I'll come on to the engagement, because this is time spent. This is not about how engaged the consumers are with the media they're using. On the TV one, that's really interesting, because for that first time we saw the break. So it's 2014, and lots of question marks about linear TV, lots of question marks about the networks. The upfronts last week, linear TV pricing and cable pricing was up about 8%, which surprised everybody. And the Financial Times wrote an article saying this means that people are shifting video spend to linear TV. We don't think that's right. There might have been at the margin some, because there's a big question about value, validation, and viewability on video, Facebook video. How can Facebook claim to be effective when a view is defined as 3 seconds, 1, 2, 3, and 50% of the time sound is turned off? How does that compare to 15 seconds on TV, or 30 seconds, or 60 seconds? Or you can have ads that go beyond that. It can't be right, can it? So we invested in a company called Comscore and Rentrack, brought them together. We own 20% of them, precisely to try and improve measurement. And the reason why pricing was up last week by 8% was we think the market was, well, there's a couple of reasons. The market was giving credibility to the fact that Nielsen doesn't measure offline effectively. When Philippe Doman of Viacom, who's under a lot of pressure at the moment, says MTV and Nickelodeon is not measured properly by Nielsen, he's dead right. He may not be quite as right as he would like to be, but he's directionally right. You don't measure on Nielsen for 7 days after insertion. We know that people watch programs they store them, and you have delayed viewing. So you can't do it for 3 days, you have to do it for a longer period of time. You could argue actually it's not just 7 days, it should be 14 days or even longer. That's one of the reasons. The other reason there is a little bit of flakiness on video, there is a bit of criticism. Remember Google, that stuff on the front page of the FT, that Google had underestimated bots. It was an important moment. They found an independent piece of research that suggested that Google were underestimating robots watching advertising. So despite the fact that there was some concern about linear TV, we saw the upfronts. The other reason why the upfronts were strong is last year the upfronts were weak. The scatter market improved late last year, and agencies and clients were worried about pricing this year. So they gave credence to the argument on viewability of offline that was underrepresented or underestimated, but they also was about pricing and things like that. So this is very important, and this is the reason why news is under pressure. Now, having said that, engagement is really important. And there is data. The newspaper industry is very poor at pulling all this together and making the case. And so if you look at this, comes from Canada, the engagement of consumers with newspapers and TVs, that's traditional media, is much stronger, we find, than the internet or digital communications. Next issue is on what's happening on retail and manufacturers and the balance between them. For the last 20 years, Walmart, Carrefour, Tesco have dominated the retail scene and the point of purchase. What's happening now is you can establish, if you're a manufacturer, a direct relationship with the consumer for the first time for many years. So retailers don't control it. So the power of the manufacturer and the e-retailer have increased. The problem is that the new Walmart could well be Amazon or Alibaba or Flipkart. They may actually control the relationship. So you've got very interesting tension building between the new retailers. And by the way, Amazon is phenomenally powerful. Remember what Trump said a few weeks ago. If I get into power, I'm going to do something about Amazon. No, well, you're laughing, but that's what he said. I know he changes his mind occasionally, or more than occasionally. But why did he say that? If you think about it, what's his constituency? His constituency is real estate. His constituency is retail. His pals are saying, you know, Donald, and he has to raise $1 billion. So that's a cynical view, but I think it's true. Internal communication is critically important. Explaining strategic and structural change inside companies is important. And it's important to that silo thing that I mentioned. Most companies, I'm sure business schools are not like it, or universities are not like it, or anybody in this room is not like it. But I have to tell you, at WPP and companies outside it, the biggest bugbear is that people don't work together. They reinvent the wheel. And the other problem is that good people are not cooperative. Oh, actually, I should modify that. Some good people are, but it's very few. And the general, you know, average people cooperate because they have to. Good people don't because they're right, or they think they're right. They have, you know, experience and record of being right, and therefore they give you a lot of aggravation. And that's why it's difficult to manage good creative people. This I've covered. If you said to me, what's up and what's down inside companies, global's more important. Regional is declining in importance. and local is up. The traditional McKinsey model is you can only have 13 direct reports. I don't think that is, or 12, I don't think that's valid today. Given the rise in technology and given the networking inside companies, it's different. And I've mentioned to this, finance and procurement on the up. The world is too short term. There's a finite limit to what you can do when reducing costs, where at least until you get to 100% market share, it's unlimited to what you can do on the top line. And the world is, there is far too little investment in innovation and branding. And you know, that chart that I showed you about retained earnings against buybacks and dividends, if I plotted investment as a proportion of GDP, it's completely inverse relationship in the US. Just gone down. The animal spirits of corporations are dulled. Maybe because of government? No. Government is still big in terms of intervention. Post-Lehman, the government, obviously Obama's claim to fame, part of his legacy will be that he righted the American economy, rightly or wrongly, after Lehman. But government continues to be the biggest force that we see, not just in terms of regulation, but in terms of investment and stimulation. And in many countries in which we operate, the government is our biggest client, particularly the year before an election. Sustainability and purpose. No company that we deal with is now greenwashes. Everybody that's in business for the long term puts sustainability and purpose at the center of what they do. And John Brown, who was the CEO of BP, did a speech at the Stanford Business School in '97 where he summed it up perfectly. He said, if you're in business for the long term, doing good is a good business. We over-intellectualize this stuff. It's as simple as that. And I can tell you that everybody we deal with who are in business for the long term really embraces it now, and it's really important. And the last point, you'll be glad to know, is about consolidation and convergence. If you sum all this up together, what does it mean? It means more consolidation of clients, more consolidation of media, and more consolidation of agencies. And the consolidation of the clients, Bayer, Monsanto. How is it that a CEO has only been there for 3 weeks, comes in and makes a $60 billion bid, the biggest in German history? Why do you think he's doing that? Do you think he's doing it because he sees great revenue synergies or revenue opportunities? Or is he doing it because he sees great cost opportunities? And the problem is that, Lex or Breaking Views, when they analyze that, how do they analyze it? They take the cost synergies, they tax them, they apply the appropriate multiple, and if the resultant sum is greater than the premium paid, great. If it's less, it's a lousy deal. And if he comes along and says, I got revenue synergies, they laugh at him. They don't factor it in. So let me just finally mention this, because this is, again, relevant to what we see. Vincent Bolloré is, I think, our most dangerous competitor. He's our smallest competitor. He controls Havas. His son runs Havas, Yannick Bolloré. And he's developed, it's a French company, so you would expect surprising things. But it is really a really interesting model, because for the first time, this does exist in Ecuador, would you believe, where an agency and a media company are together. But for the first time, you're seeing a combination that we haven't seen in our industry on scale. Through his private company, he controls Havas, which is our smallest competitor. It's about 15% of our size. And it buys, plans media. He controls Vivendi. He pyramids. He only owns 25% of these companies, 25%, which own 25%. And through Vivendi, he now controls Telecom Italia. And through Telecom Italia, he's just bought Berlusconi's Mediaset premium service, TV service in Italy, which controls a premium TV service in Spain. So this is a Franco-Italian-Spanish operation. And he controls Universal, which is 1/3 of the music market. They sold Activision because Bobby Kotick wanted to buy it back, but they're now doing a hostile on Ubisoft and Gameloft to get back into the gaming business. I put this up because it's a really fascinating combination. What's that? Too long. Sorry. That's it. Finish.
I'm not going to waste any time on introductions, but this is Simon Fox here, this is David Abrahams here. You've been hearing from Sir Martin, and I hope, because there are some really interesting people in the audience. So I'd really like you to talk, not least because I've got a slightly croaky voice. And if anybody's got some strepsils, can they let me know now? But I think I should just be able to get through this. That was fascinating and quite frightening. If you were a media owner, and a legacy media owner, today, for 200 years, the model for media ownership, or for newspapers basically, was that some people would pay for the content, but advertising did the rest. Yep. And at the end of your talk, I'm still not clear whether if I was a media owner today, I would be building a model that relied on advertising, because so much is changing so fast, so rapidly, and so unpredictably.
Well, and I didn't do this, I should have done. The 73 billion for a minute. What's our biggest investment on behalf of our clients? Google. Last year was 4 billion. That's the biggest. The second biggest would be Murdoch, Fox, Star, Sky, at about 2.3 billion. The next biggest would be, let's say, I went without naming them specifically, between Viacom at 750 and RTL at 1.75 billion. And then there's the second biggest internet one would be Facebook at 1 billion, up from 640 million the year before. Google went from 2.9 to 4 billion, but because we bought Essence, it's really 3.2 to 4 billion. Twitter went from 150 to 250. And the AOL, Yahoo, well, I think AOL will end up buying Yahoo, famous last words, but the Yahoo Verizon group would be around 750 million, with Yahoo going up from 400 to 430. Very interesting. I checked this morning. Twitter is going to be up to 320 this year. So it went 150, 250, 320 for us. Snapchat, Buzzfeed, very small thing. Now I mention that because that tells you the answer is advertising every year of those 31 years has kept on going up. And what you're looking at it is from the perspective, with all due respect, of somebody who's a legacy primarily.
I'm out of it, yeah.
But yeah. That's your experience, a legacy company, as we all are. We're all legacy companies. The fact is the market has grown. It's coming in uncomfortable places. This year we will do 5.5 billion with Google. And we will do 1.7 billion if we were up with Facebook 68% in the first quarter. But just think about the 4-to-1 ratio of Google to Facebook. Facebook seems to be the sexy one, the one that's catching up with mobile and video. I do not agree with that. What we see is search being the fundamental driver. Search and video, as YouTube. And just one final thing. YouTube views are long, but smaller number. Why? Because people are searching. Facebook views are many, but short. Why? Because it's a social medium. People are talking to one another through different means. The point of the story is that advertising in that environment is still extremely important. How do you deal with ad blockers? You get Google to turn off ad blockers on YouTube. That's the most potent way of dealing with ad blockers. Or content owners who have content that consumers value say, we won't supply you with the content unless you turn off your ad blocker. And we as agencies create better content, true. We have to do that, make it more contextual. When I'm using my mobile phone and I'm playing a video game, nothing annoys me more than when an ad pops up, and I'm in the business.
So, legacy players.
Well, we're a legacy player too.
How did you feel at the end of Martin's talk, did you feel that you wanted to go away and find a new job, or did you feel, were there sort of shoots of light that you saw there that you found encouraging? Simon?
Well, I'm an optimist, and I think you've got to be an optimist if you do what I do. You know, I'm kind of used to the narrative. I mean, David gave an intro, a narrative which suggests that legacy media is suffering from all these terrible problems, you know, we're all doomed, and we're running around in a dad's army like way, and you know, that's just not the case. So our job as media owners, legacy or otherwise, is to create compelling content, distinctive content, relevant content, and to attract an audience to that content, and then to monetize it successfully. And as Sir Martin said, there is more money going into marketing, advertising every year, maybe clearly less into print, more into digital. So our business needs to change, and I think if you look at so-called legacy news brands, Daily Mail, BBC, Guardian, ourselves, we're doing incredibly well. We are bigger in audience than most of the startups, and we are attracting good digital revenue to fund that journalism. So, of course, the world is changing, but if we continue to create content, I believe we will find advertising dollars that come in and support that. Maybe not as the only revenue stream we have, but as a very important one.
You really are an optimist, aren't you?
I am an optimist.
So you're so optimistic you started a newspaper recently.
Yes.
Was that a little too optimistic?
Yes.
So what didn't happen that you thought was going to happen?
So for those of you that don't know, we opened a paper called The New Day. We ran it for 8 weeks. Unfortunately, we closed it. I mean, I'd say a few things about it. Firstly, I think that if you always do what you always do, you'll always get what you always get. So the organisation that I run is one where I want to encourage innovation. And I'm quite happy to try things and fail fast, learn fast, I should say, learn fast. In the case of The New Day, we actually thought, we did a lot of consumer research, and people told us that there was a reasonably high level of dissatisfaction with certain news brands. They didn't want to be told what to think. They didn't want editors or proprietors' kind of political views pushed down their throat. What they wanted was a balanced product that gave two sides to an argument. They didn't want an unrelentingly negative news feed every day. They wanted a certain amount of positivity. And so we thought that we could innovate with this new product. And editorially, I think it did exactly what we hoped it would do, but changing people's behaviour was harder than we thought. And we set some pretty clear timelines around it, and it didn't hit the target, so we closed it. So it was clearly too optimistic.
And David, when you saw that slide with television waiting for a correction, do you agree with that?
I'll come back to that in a second, because I think the gap is made up by the OTT viewing of video, and much of which we produce. But I think, you know, perhaps my contribution could be to shift the conversation to an aspect of what journalism actually is. And I say that with great respect to someone who's edited a national newspaper for many years very successfully. It is both their product, but it is also part of our culture, and it is part of our democracy. And the aspect of journalism that interests me and concerns me the most is the funding of proper journalism, and the funding of journalism that seeks to kind of inform the citizen of what's actually going on. And that comes in many different forms, but for Channel 4 in particular, for Channel 4 News, it does involve investigations, it does involve sticking with stories and finding ways to fund those investigations, which has to be effectively cross-subsidised from within a business model. So we are in a privileged position. We're a public service broadcaster that has commercial revenues, where we do things which are profit generating that then fund the aspects of the remit that the government give us to deliver to. And news and current affairs is an important aspect of that. And Channel 4 News is produced by the wonderful ITN and John Hardy, who's sitting over there. And together what we've been doing is we've been working quite successfully to both maintain the standards of the investigations that we pursue, such that they can have massive impact politically and socially and culturally. And I can reference right now the fact that people are starting to pay attention to the fact that we've single-handedly looked into the election expenses of the last general election, which has led to 22 police forces, 11 police forces looking into 22 constituencies that could in effect call into question the legitimacy of the government's majority. This is a story that now is going to be covered by other news outlets as it rolls through the Electoral Commission. But you see, those kinds of stories don't come from a profit maximising starting point. They have to come from an independent group of journalists working in the pursuit of finding out the truth, and sometimes sticking with stories that might go on for months, if not years. So the thing that concerns me most in this debate this evening, whilst the economic models are clearly changing, is what kind of society do we actually want to live in? And do we have an independent media that can operate separately from the sort of church and state model of funding that we have been used to for, frankly, centuries? And I think this is a profoundly important public policy issue. And I think all of those of us who are in positions of huge responsibility should be speaking forward about the importance of news plurality in general, and in particular in a country like the UK, where we have founded so many of these important delineations between the media and the state and the fourth estate. So in terms of the business model, we have done a series of experiments which have allowed us to move forward quite successfully. We're a £100 million revenue business. 100 million of that is now online revenue. That's a reasonably good ratio. But what we have done is innovated with data. We started our journey 5 years ago. Half of all the 1634s in the UK are now registered directly with us. And that allows us to offer Sir Martin and his agencies a superior first-party data solution, which is what they primarily looking forward to be able to deliver advertising in an addressable way. So we are one of the only media companies in the world that have delivered and accumulated a data platform at scale. And because we took a view that our viewers trust us, they trust our brand, they will share their data with us, and we give them full control over it. And we've done something quite unusual there that's allowed us to sell our online video at the same price as our prime time viewing experience, which is not happening anywhere in the world at all. Because it is highly effective and the return on investment for advertisers is very, very good. So we've worked very hard on understanding what our role is in society, and we work very hard on innovating technically and commercially. But the most important thing of all is that we've also innovated in the way in which our product can be consumed. And I agree fully with what Sir Martin said about how people consume news. The difference I have with him about Vice is I don't think they are yet putting the resources into doing the serious journalism that actually society needs.
But that's where I differ with you. See, because I think that's, what's happening is it's being crowdsourced. And what I mean that is you go to Brooklyn or to Shoreditch or Venice Beach, which is where the three biggest, and I'm not holding out Vice as being the paragon of virtue, and as David said, they've run into some issues, but they have built.
You invest in Vice as well.
Yeah, we have 8.4%. We're the second largest investor after Disney, which has 25, and Fox is at 5, and then you have the HBO Time Warner production agreement. Where I disagree is this is sort of crowdsourced journalism. If you go 12 midnight on a Saturday night to the edit suites, of which there are 50 or God knows how many in Brooklyn and Shoreditch, you see kids, pounding out content, and it's this. I use the word crowdsourcing because we have a conventional when you talk about investigative journalism, you have a conventional view, I think, or we have a conventional view, because I put myself in the same camp as you, of what constitutes investigative journalism. It's changed. Life has changed. I mean,
Could I just ask?
Well, it's very annoying to me, but
okay,
some,
but can I just give you
some
some
clients
facts?
crowdsource creativity.
Okay, let me give you some
it.
facts from actual consumption of news in the UK in the first quarter of 2016 on Facebook. John Hardy.
You quoted New York Times' Mark Thompson and others compared to Shane Smith and how they were stuck in the past and the only person that got it was Shane. So actually, very much aware of that, Channel 4 decided 2 years ago to invest and challenge Channel 4 News to say, you need to reorientate entirely your digital strategy to focus on the younger millennial audience, to reach them wherever they are with the content, but do not dilute what we do. So don't send them out videos of cute cats and sinkholes in Colorado. We want high fiber, Channel 4 News, international domestic investigation, make that work. And this is what happened, David alluding to. So at the start of 2015, Channel 4 News may have had something like 5 million video views digitally, in addition to a news program which reaches about 1 million a day. Through completely changing what it does, in the last 90 days, Channel 4 News is viewed by 90 million on Facebook. Now, it's not 3 seconds, Martin. Over 65% of the views on Facebook are for more than 1 minute. And the rest mostly go into 2 minutes. And this is not, as I say, cute cats. This is Macedonian kidnap gangs. This is jihadis living next door. And you know, the investigation into the Conservative Party election expenses, the allegations, was entirely created by Channel 4 and completely overlooked by all those kind of new up-and-coming organisations. For perspective, in the last 90 days, our views on Facebook and Channel 4 News are 275 million. The Vice News is 27.8 million. A ratio of 10 to 8, and not 3 seconds. This is full-length views. And how they've done that is actually by taking a totally different approach to how you edit and present the high fiber news. So if you look at a video that Channel 4 News does on Facebook and compare it to what's been on television, it's the same core journalism, but done really quite differently, and it works. So my point is, taking a leaf of the kind of challenges that people like you made to the likes of Channel 4 is we did it. We said, let's move away from the old model, which was, if you build it, they will come. You build a website, a destination website, and you try to drag people to it, which is fine if you're the BBC, which is maybe fine if you're the Guardian or Mail Online, but almost nobody else can compete with that. Instead, by using the emergence of social media and mobile, you can actually, as a nimble organisation with far fewer resources, without diluting your core journalism, actually go further than some of the new kids on the block.
I put it slightly differently. You see, I think you've done, it's what we try and do. It's the only response that legacy businesses can do. You try and get, so those 4 agency, the orange blocks, the verticals, they're the more traditional businesses, get them to move as fast as they can into digital. The digital businesses like Wonderman, Ogilvy, One, AKQA, Possible, VML that we have, Miram, they're digital businesses that are in the right place, move faster. And then the third thing is cannibalization. If you don't eat your children, somebody else will. So you invest in Vice, you invest in Media Rights Capital, which does House of Cards for Netflix. You invest in Peter Chernin's Full Screen with 100 YouTube channels. You invest in Refinery 29, which has content for... I don't disagree with the strategy. All you're saying is you're endorsing, in a way, what Shane Smith... The thing I sort of viscerally dislike is the sort of suggestion, and it's I'm going to use the word, I'm going to be very aggressive about it. It's a snotty view that young people, that the new generation, are less serious. Let me be rude back
from my own experience. Let me be rude back from my own experience. So basically, Vice came to Channel 4 3 years ago and tried to do the HBO deal with Channel 4. Why did they do that? Because they need to nest their content on a network. Okay. So we said, this is very interesting. I went to see them. Okay, I thought it was fantastic. So let's give this a go. I mean, we work with hundreds of producers up and down the country. So we sat down and we hoped that they would do a 1-hour documentary for us in prime time. And what we realised is some really basic things, which is, first of all, we have to be Ofcom compliant. We have broadcasting codes in this country about the safety of the journalists and the accuracy of what they're saying and the impartiality of what we're saying. Now, the fact is that we all exist in that ecosystem. It's been built up over decades and it has some value. Now, you could say that's snotty and you could say that that's old-fashioned, but it's actually delivering public value.
Yeah,
so
but David,
the
that's the
question
same
is,
argument that the hotel companies use about Airbnb. They're not subject to the same regulations. They're not food and health and safety. The world has changed.
It has changed,
and it
but,
has
but,
become,
but John's just
it has
shared,
become
but,
more anarchic.
But John's just shared data that says we are being viewed 10 times more on Facebook than Vice is in the UK. 10 times more.
Hold on a second. We've had a lot of trouble on getting Facebook, and I know this is on film, and I'll say it. A lot of Facebook focuses on outcomes. If it's outcomes, you have to have independent data to measure it, and their data is not independent. That is going to change because of pressure that we and others are putting on them. Google controls the data. Amazon controls the data in walled gardens. That has to change. Don't say to me that those figures are sacrosanct. They aren't. They aren't independently audited.
But those are independent.
No. They aren't. They aren't. No, it's fact. They aren't. And it's only through pressure that we put on, that we and others have put on them to get them to do it. They're not measured properly. And I don't care what you say. Our clients, Keith Weed, who is on the Facebook Consumer Council, so he's one of their biggest, he's the one who mentioned the 3 Vs. He's the one that questioned the value. He's the one that questioned the viewability. He's the one that
the revenue still went up 60%.
Can I ask, I'm just interested, because I thought we'd end up talking about Facebook. You say Facebook is less important than Google, but all those millions of views, do you get revenue from them? And what about the data? Because you're very focused on the data.
Yeah.
So do you know who those people
are?
Yeah,
so basically we are in a privileged position as Channel 4 because effectively we regard this as a way of extending the reach of delivering our public remit, okay? So that's a different model because elsewhere in our schedules we're delivering commercial revenues that can help to pay for that. So we're not primarily concerned about monetizing, which is why it has to be stated in this conversation that if you're relying on Facebook to pay for the journalism, it's going to be much more challenging, which is what's happening with Buzzfeed. But let's face it, newspapers have always been cross-subsidised by tycoons or big conglomerates. They've always required or trust, because they've always required that cross-subsidy. There's nothing wrong with that if you believe that they have a purpose that's above and beyond simply being business units.
Simon, is Facebook, you can't afford not to be on Facebook.
Yeah, that's right.
I mean, we presents you with a massive problem, doesn't it?
No, I don't think so. I mean, so we're a public company. Nobody, sadly, supports us, and we're a very profitable company, I'm pleased to say. And I believe that our content should be consumed wherever our readers want to find it. We love readers who come onto our sites directly, our national or our local sites, but equally, if they are on Facebook, which is where the average person is spending 44 minutes a day at the moment, I would like them to find my content there. If I choose not to put it there, they simply won't find it. So we embrace the notion of distributed content and platforms. We've embraced Facebook instant articles. And for those readers who choose to read our news on Facebook, there is a revenue share.
Is it much of a revenue
share? It's 70-30 in our favour. You have a choice on Facebook. You can either sell the advert yourself and keep all the revenue, or you can allow them to sell it, and they will take a 30% commission, and we have 70%. And
can you tell us tonight what you're earning from Facebook?
No.
Is it significant?
Yes, it will become significant.
But not at the moment.
It's not insignificant.
Not insignificant. No. And I'm really conscious that this isn't all male panel. Something Oxford should never do. So I'm going to. There's a woman here. Thank God we're hearing from a woman. Oh, so question here.
Hi guys. My name is Mimi Turner and I'm the marketing director of the Lad Bible. I don't know whether people know it, but we are a digital youth content company. We reach about 400 million people in a 28-day cycle because our content is on distributed platforms.
I'm going to
That's
press you to answer a
110
question because
Yes.
we've only got about 8 minutes
yes.
left, right?
But we have some skin in the game that you are talking about, and I wonder if it's possible to step. I'm a fan of television. I was with Express newspapers. I'm a fan of print, but I wonder whether we are spending a lot of time saying my news is real news and your news isn't. That doesn't seem to be an argument that can be progressed. David's point is core. You have invested in knowledge. And I think, Alan, your business invested in knowledge, and Simon, yours, you invested in knowledge. But you're not audience, your audience building is not working for you. There are people who are audience builders. And I think that somehow that has to be the axis of development. You've got knowledge, other people have got audience. Somehow that model has got to work because television, upstart publishers like ourselves, legacy publishers like The Guardian, we're the people walking around New York City, and there's King Kong, and there's Godzilla, and there's a smog monster, and they're just wandering around, and they have enormous power. Martin talks about them as being media companies. I think they're audience owners. They are audience owners. Everybody on that panel used to be audience owners, but now there are bigger audience owners in town. So rather than having these rather negative, not going anywhere debates about my news, your news, there has to be some other stronger approach, because I think otherwise, David, you're right. It's going to be very difficult, not to make news, but for news to be discovered, and that's the problem.
My name is Johnny Ryan. I'm from a company called PageFair, and we're focused on ad blocking. So I want to ask a question about ad blocking. I think we've probably fallen into some terrible trap over the first 20 years of the web. We've fixated on metrics, and the metrics we fixated on, this is now the antithesis of everything that's come before. The metrics we focused on have been the easy ones to measure, and they may have pulled us on the web towards the bottom of the marketing funnel. A focus on below the line spend. And we end up with this shouting match on your properties, especially, I used to work for the Irish Times, especially on newspaper websites, where the ads have to shout over each other to get attention. And so the web, instead of becoming a premium, uncluttered marketing space, has now become a space where 200 million people at least are in some form of rebellion against it. So the question is, so the question is metrics, and it's particularly directed at you, Sir Martin. Do you think, you were talking about short-termism and sustainability, is there some new way of measurement that is going to prevent procurement departments and brands from engaging in a race to cheapness, which you described, and bring us out of this mess, and maybe make the web slightly higher up the funnel medium?
Well, I'm gloomy about the short-term prospect because I don't see. The primary determinant is the new normal, so it's the low GDP growth. So the real question is, how can you get, it's sub-trend, so pre-Lehman, GDP growth, both real and nominal was greater. 3.5 is not sufficient, I think, to change this. So what's the reason for upside breakout? Monetary policy has been the driver since Lehman, zero interest rates or close to zero interest rates. Until we get some sort of fiscal stimulation, it's not going to change. So I would be quite negative about it. And just on your question of procurement for a minute. So what happens when we go into a review? This is factually true. The procurement department says they want a template of the media on the media plan. They want a buying. Here's the strategy. Give us if we're the incumbent, our competition wants to drive down the price in order to win the piece of business. They give the template to the procurement department. The procurement department doesn't go, or the marketing department never goes to the media owners and says, "Is this price achievable?" They accept the template at face value, The procurement people in the short term are the heroes because they appear to have driven down the pricing. And over the coming year, because the variables move and you can never track it properly, nobody can figure out whether they did get the savings that were promised or not. So the whole thing is a short-term model. So I would say for the next 3, 4, 5 years, I don't see it changing. And if you can think of anything that is from a macro level, apart from a change in economic policy, which has to be more fiscal, and then you get to the question of deficits and funding deficits. I don't see
Martin,
it.
can you give us the 1-minute guide to, because we've only got 5 minutes left,
Sure.
time for it, but the 1-minute guide to programmatic selling and how that's going to change the world, or how it is changing the world?
Well, it enables us, so let me just give an example. We have the profiles of 200 million adults in America. So we know, if you were an American citizen, we don't know it's Alan Rusbridger, but we know you as a number. We can target precisely, depending on the data we have on you in terms of media habits, purchasing habits, and we can link the databases. Now we have our own data, first-party data, we have access to others. We can target the ads and make them highly contextual instead of random. I mean, that's simply it. So we can target it at you depending on, if we see you investigating automobile sites, looking for a car, we can serve you an ad of an F-150 or whatever it happens to be.
Machines are doing it.
Machines are doing it. Is
Yeah,
this
yeah.
good or bad for these two other gentlemen on the panel?
Well, there's so much inventory out there. The only way of serving ads is programmatic. Programmatic trading will grow, and I think there are plenty of opportunities for yields to rise if it delivers response for advertisers.
And we do programmatic already. We're the first people in Europe to do it, broadcaster, and we deal with ad blocking. We don't have any ad blockers operating on all 4 at all, and we're reaching millions of people online every day through that service because we've got high quality video content, and we've got a very strong brand, and we've got first party data, and we're trusted. So my view is that if you've got those things, ad blocking isn't an issue. You just send a polite notice saying, hey guys, you want to watch our great content, there's no ad blocking, and all 4 doesn't suffer from that issue. But you've got to have the quality. You've got to be a great creative content provider.
I'm going to try and group 2 questions here, one here and one here. And if we can afford 2 microphones, or if we have 2 microphones, this is wonderful. So try and make them pithy and quick because we're running out of time.
Yeah. I am Ambesh, student of Saïd Business School. Very quickly, there are 2 forms of news. One is opinion and the other is the instantaneous news. While we consume instantaneous news, a lot of traffic is driven via social media. So what I may be looking at today at Guardian, tomorrow I may start looking at New York Times, depending on where I am and whose feed do I see. So how do both content creators and the advertisers feel about this inconsistency in traffic, because it's all driven via social media, and which neither of you sort of control?
That's a question about brand?
No, that's a question about how do content creators and advertisers feel about it, because there's no consistency.
Okay, and a question here.
Yeah, I'm a fellow at the Reuters Institute. I'm also a founder of a media company. This question is specific to Sir Martin Sorrell. I knew you grew primarily through acquisition.
Well, when you start as a wild basket manufacturer,
Yes,
and
yes.
you want to do what we want to do,
So-
there's little option.
Yeah, so the question is, when you acquire companies, what is it that you do? Do you also go with your gut instinct, or are you a very numbers analytical person?
I'm a bean counter.
That's a huge and interesting question for the Saïd Business School, but probably takes us off subject tonight. But do you want to just deal with that?
I think it's a
social
very
media question.
good question you've asked about how do you hold on to your brand when you're both owned and operated on your own platform. So we are linear networks and we're online consumption owned and operated, and you're syndicating content through these new social forms. And I think my answer to the question from Channel 4's perspective is we have a phenomenally strong brand, and we have brand values that are editorial, and we have very strong journalists like Jon Snow and Krishnan and Matt Fry who are known to be perceptive, analytical, and giving you insight. So as that content is repurposed and syndicated through the platforms, it still echoes with the strength of the brand. It must be harder to start from a completely new place without that so-called legacy. I regard a legacy as a tremendous strength.
your brand, and just say something a tiny bit about scale, because the Daily Mirror used to be a huge brand in Great Britain, and yet when Martin was listing all the places he advertises with now, the Daily Mirror is a minnow now, isn't it?
Well, in Sir Martin's world, that's probably true. We are, though, the second largest digital news brand in the UK. Not the Daily Mirror, but the Trinity Mirror network. So virtually the same as Mail Online. So as a news network, we're not a minnow. There are nearly half the population will access our sites every month. I mean, what we're doing actually regionally is really trying to focus on the populations of the cities we serve. So in Manchester Evening News, 10% of the city of Manchester come onto our site every day. I'm much more interested in building really loyal local or regional audiences that come to our sites every day, and that's what we're focused on. But to the question about Facebook, I think there were some stats out the other day that about 50% of the news that you read on Facebook, you are unaware of which brand is delivering the news, and 50% you are. And I don't think that's particularly surprising, because big global news stories, inevitably there is a certain similarity in the reporting. But we are in a world where news has been disaggregated. It used to be that people got all of their news from one news brand, and that's the same in music, the same in news. There is a disaggregation, and if people choose to consume their news through Facebook or any other news aggregator, then there are absolute benefits to doing that. Facebook is clever enough, of course, to know which ones you tend to look at most, and then you'll get more of that brand. And our task is actually to persuade you to come to our site as well as browsing on Facebook.
These are three such interesting figures, and I suspect if we allowed them to run, they would have a fantastic argument, and we'd all have a great time watching it. But unfortunately, partly due to Oxford traffic and other reasons, we've run out of time. So I just want to, well, actually, it's not for me to thank them, because Peter's going to thank them, but it's been a fantastic panel, and I'll now ask Peter to wind up the evening.
So may I, first of all, thank our partner at the Reuters Institute, Alan, Sir Martin, David and Simon. Thank you for your contributions today. This was a spirited discussion. I would look forward to dinner for some of us. We'll continue this. Can I also invite everyone out to outside for drinks? We can continue this conversation a bit over drinks, and you might get a chance to ask a few questions that you haven't had an opportunity to do so. Can we thank our panel very much and welcome them to Oxford.